Hi there, I'm Ken Majmudar. Thanks for watching our YouTube channel, Investing with Ken Majmudar. In this video, I want to talk about initial public offerings, IPOs for short, what they are, how they work, and whether or not they're a good investment opportunity for most people who might be watching this and curious. So first of all, the definition of an IPO is an initial public offering. So as you guys probably know, most companies in the world are private companies. So somebody starts them, somebody buys them from someone else who started them. Most companies, in the United States, there's millions of businesses. The vast majority of those businesses are private companies. And that means that their stock does not trade in any markets. It's owned by whoever, usually a small number of individuals or other entities. They could be divisions of other bigger companies, or they could be owned by individuals. Maybe many businesses are actually family-owned businesses. So most companies are private. That means that they're not publicly traded. That means that you and I cannot just buy or sell ownership in those businesses. But a much smaller number of companies are what's called publicly traded. So that means that they are listed typically on a stock exchange, like the New York Stock Exchange, or another really famous, well-known exchange is NASDAQ, or they might be traded on something called the over-the-counter exchange, which is not exactly an exchange. It's just people that trade. OTC is an exchange, but there's also companies that are public and they're just traded among market makers without a formal listing. So in any case, if once a company is public, it's different because it has certain obligations to report results to investors, and typically most companies, they report results every quarter. So every 3 months they have to file a quarterly report, which is also referred to as a 10Q, and every year they have to file an annual report, which is also referred to as a 10K. So these are requirements by the SEC, or Securities and Exchange Commission, which regulates stock markets, it regulates investment advisors, and it regulates public companies, and it actually enables companies to go public if they follow certain rules. So in the case of IPOs, this is a process whereby a formerly private company has made the decision to become a public company. And so an IPO, or initial public offering, is the process through which a private company becomes a public company and therefore can be owned by many investors and traded in the public markets. So at one point or another, the vast majority of companies that are public companies today were at one point private companies. And so at some point in the past, they underwent their own IPO, or initial public offering, to then become a public company. As an aside, by the way, public companies can also go private, so that you do see that happening in reverse as well. So instead of an IPO, sometimes companies go private, and that's called a buyout or a merger, or sometimes a leveraged buyout, LBO for short. Most of those things are when private companies are staying private, or often public companies are being taken private. So IPO is not to be confused with any of those going private type transactions. So before we go more in depth into how IPOs work and how companies actually go public, let's talk about why companies would want to go public. So there's many reasons why companies go public. So remember that with a private company, the shares are not traded. So if the owners want to convert their ownership of their company into cash to spend, they really can't do that very easily. So they really pretty much have only one option, which is they have to find someone else who wants to buy the company. But at that point, if somebody's buying the company, if they're buying the whole company, then they can control the company. But if they're buying a small piece of the company, or if the owners want to sell just a small piece of the company, then it's pretty difficult to find somebody to buy a small piece of a company where that person won't really have any say in the management of the company. And also, they don't really have any information because a private company is not under any obligation to share its results with anyone. And they also, what if they want to get out? What do they do? So because of all those reasons, many times, one of the reasons that companies want to go public is what's called liquidity. So that's basically giving their owners the ability to now get some benefit from their ownership in the form of being able to sell some of the ownership when they choose to sell it for whatever the market value is at that time. So in contrast with the private company example that I just gave you, if a company is already public and its shares are trading in the stock market, and let's say it has hundreds of owners or thousands of owners or just 5 or 10 owners initially when it's private, once it's a publicly traded company, the owners, after a brief pause called a lockup period, they actually have the ability, if they decide that they need money or they want to diversify their ownership or their investment in the private company has done really well and they want to cash out and just have money to spend on other things, a publicly listed company, the owners of the publicly listed company have the option to sell shares when they want cash at whatever the price happens to be at that time. So one of the reasons that private companies go public is to give their owners the ability to sell some or all of their shares into publicly traded markets. So that would be one reason. And that reason, to summarize that reason, it's called liquidity, because the owners basically now have the ability to liquidate their shares in exchange for cash through the public stock market. So that would be one reason that that private companies become public companies and go public. But there's other reasons that companies go public. So a second reason is access to capital or to raise money. So many times private companies have growth opportunities. They have opportunities to invest in new plant or new equipment or new products, developing new products or new services that they want to develop. So a second reason that companies go public, besides giving their owners the ability to realize their value that they've accumulated through the success of the company, is to raise capital for different needs that the company has. So for example, a company reaches a certain point, they can always go to their private investors and ask for more money, but that's relative to public markets, that's a limited source of funds. So companies go public in order to raise larger amounts and to, basically get access to capital if they have growth plans or they have things that they want to do to invest in, more so than the profits that they have at any given time. Sometimes when companies go public, it's not even necessarily that they're profitable. If the plan that they have is sound and investors are interested in betting on the future of that company, companies often can go public without any profits. And that's actually been more of a recent change. Like in the past, there was a time when I think most of the time the SEC wanted to see profitable companies, but in the last 20 or 30 years for sure, and maybe even before that, a number of companies did go public even without profits based on the business plan, the strength of the management, et cetera. So they tell a story to investors, investors buy in, and the companies go public. So a second reason to go public is to access capital, to raise money from investors for the growth of the company. A couple of other reasons that companies might want to go public is to create liquidity, not just for the owners, but also for employees, and to basically, once shares are publicly traded, then incentive plans that employees might be given, for example, options plans or bonus plans or things like that, restricted stock, all of those things are definitely, in the eyes of employees and probably in everybody's eyes, more valuable when a company is publicly traded, because then you can actually see what that value is when you get shares or when you get options. You have a more likelihood of turning that ownership at some point into cash. So another reason that companies go public is that they want to use the public currency as an incentive for their employees. Yet another reason that companies go public is that they want to create what's called currency. So once their stock is publicly traded, right, anybody can look up what the value of the company is. You just take the total number of shares and you multiply by the price in the stock market, add the debt, subtract the cash, and you have a pretty good estimate of what the public market, in the form of all the investors in the public market, think about the value of a particular company, And so once you have a company that's valuable, and let's say that it's executing, or just investors that are excited about it, then in the public markets, the value can go up quite a bit. And as long as the value is robust, the company can raise money with its stock at that point, just hire a banker to do what's called a secondary offering. Or many times what they can do is they can go to other companies or other people that own assets that they want, and they can, instead of offering them cash, which they either have to make through profits or raise in the public markets, or borrow from a bank or borrow from investors, instead of using cash, being publicly traded can give them the ability to give stock instead of cash. And so there are companies that are public, and their plan or their business plan is to basically buy other companies and using their stock to do so. Companies that kind of do that as their main focus, where they're trying to consolidate a more fragmented industry, that are called roll-ups. And in general, roll-ups have had a kind of a checkered past as investments and as IPO companies. But certainly that is another reason that companies do go public. And I think yet another reason is that, if a company's successful and it has a recognized brand, and there's sort of a bit of a prestige that goes with being public, I think in most cases, to say that, I run a public company or I work for a public company. Bankers, I think, are more comfortable on the whole, banking public companies. So with all that having been said, the number of public companies is not really that great as you would think. Like I mentioned, there's millions of private companies, and definitely hundreds of thousands of, substantial private companies in a country like the United States, with the very large economy that we have that gets into almost the $20 trillion range. But in terms of public companies, there really are far, far fewer public companies. So I would say that in the United States, I would say that the number is something like under 10,000 publicly traded companies. And even the 10,000 is really overstating it, because the majority of the value in public markets is concentrated in the largest public companies. So, today it's September of 2020. The biggest publicly traded company, I think, in the world is Apple. And that value is around $2 trillion. And that was a little higher, but we just had a little bit of a tech correction in these last few weeks. And so it's around $2 trillion right now. But only a year or a little over a year ago, Apple was a $1 trillion company. So it's almost doubled in just over a year. One of the reasons is they announced what's called a stock split. So they split their stock, and investors got excited about that. So Apple is probably the largest publicly traded company, but other very, very large publicly traded companies are household names. So that would be companies like Amazon, Google, Facebook, are some of the largest companies in the world. And no surprise right now, because of how well technology is doing in the markets and the growth and importance of technology in our lives. Pretty much the largest public companies, a large amount of the biggest public companies happen to be technology companies today. But there's obviously large companies in many sectors, think ExxonMobil in the energy space, or even companies like Salesforce.com, is a substantial company in the technology space, a company like McDonald's, Starbucks, and so forth. So there are many publicly traded companies. Now, how do companies go public? I mentioned why they go public, so let's talk about how. So the most traditional path to go public is that a private company would hire what's called an investment banking firm. So, and I know a lot about this because I used to be an investment banker in my previous life before I started Ridgewood Investments and became a full-time investor helping other people invest their money. So as an investment banker, we would go to companies that had expressed an interest in learning about how to go public, and we would compete with other investment banks. So obviously the names have changed somewhat, but when I was an investment banker, I used to work for the investment banking side of Merrill Lynch. Prior to that, I had worked at a company called Lehman Brothers. So Lehman Brothers is now Barclays. Merrill Lynch is still Merrill Lynch, but it's part of Bank of America. Merrill Lynch, Goldman Sachs is still around, Morgan Stanley is still around. Some of the firms that aren't so much around, like CS First Boston, and Solomon Brothers, and a few others, older investment banking firms that have sort of since consolidated or disappeared. But there's still basically 5 or 6 main investment banks, and then there's quite a few, a second tier of 5 to 10 firms, and then even a third tier and a fourth tier. And I don't mean that pejoratively, just sort of by size and the size of the deals they do and how extensive their reach is. But so essentially, in order for a company to go public, the most traditional route is that they would hire an investment banker or two who would lead the process to go public. And since I did this, I can describe in great detail how the process works. So the investment bankers sort of, write what's called a prospectus. They describe the business. They describe the risks associated with a given company. They work on what the valuation of the company should be based on other companies that are already publicly traded. And then they actually do the IPO. So what that involves is you actually file the documents with the SEC, and the SEC reviews the documents. They give you comments, and then they say, we like this. We think you should describe more about this risk, or we want the financials presented in such and such a way, although there's certain standards. So for the most part, you already know what to do, and you have to work with the CPA firms, to get audited financials, all that kind of stuff. And then once you've got that all done in the prospectus, you create a presentation for the company to describe their business more in sort of qualitative and somewhat quantitative terms. And so you give everybody a prospectus, and as the investment bankers, all the investment banks have a sales force, so they know all the big pockets of money in the whole world, in the United States, in the Middle East, in Asia, in Europe, and somewhat in Latin America. And so when you're an investment banker, you're working with the company, and you're ready to go public, you go on what's called a road show. So that's kind of a whirlwind, usually 1 to 2 weeks. And the really big offerings that are globally significant, it might be 2 to 3 weeks and multiple teams. And so you'll take the CEO and the CFO of the company. You go and visit, every day you're making 10, 15 meetings. And so the idea of all these meetings is to build a book of demand. So every meeting that you do, afterwards the salesperson follows up and says to the institution, hey, how much would you like to order of the shares? And so sometimes IPOs are difficult to sell, and sometimes they're really hot, where there's way more demand than there is supply. So obviously with the hot IPOs, it becomes a question of who's going to get the allocation, because basically everybody expects that the price will go up once the company starts trading, and it'll be a quick layup for the early investors. So it becomes an allocation game. For other IPOs, of course, there might not be as popular for whatever reason, and so it takes a little more work for the investment bank. But all the investors know that there's going to be a secondary market, because as soon as the company goes public, it's going to start trading in the stock market. So all investors have the ability to sell their ownership. So it makes it a little easier to sell it, because they know that they're not locked in. However, they do want to not have a lot of investors early on who will sell right into the market when it trades, because then it's a prestige thing. Everybody feels good when the IPOs go up. So on the one hand, the companies want a high value for the shares that they're going to be selling, but on the other hand, from a reporting and a prestige and journalism point of view, companies want to be known as successful in their IPO, so that often is judged based on how did the stock do immediately after the IPO. But that all having been said, are IPOs great investments? For most investors, I would say probably not, because there's so much demand building and hype on IPOs that often the valuations are actually relatively high. And there are some studies that show that if you invest in if you invest in every single IPO, 6 months later, 3 months later, 6 months later, the average IPO price goes down. But that having been said, some IPOs, think a company like Amazon or Google or Facebook do so well after their initial public offering that, of course, if you had the fortitude to hold on or buy early, you would do really, really well, and it would make up for a lot of other ones that maybe didn't work out as well. And there is a bit of a quid pro quo in the game because, as I mentioned, some IPOs are really hot and in demand, and getting an allocation is very tough. And it's basically like a layup if you do get an allocation to make a quick gain. Whereas other IPOs are not so hot, and so it takes more work to place. And so naturally, the institutions that are the most, that have the most money, that are the most active, they're the ones that probably have the most a wherewithal for the investment banks to, when the IPO is hot, to decide, who to give it to. And so to some extent, there's a quid pro quo that goes on where an institution that's loyal and they've bought into this bank's IPOs, even the harder ones, then get rewarded by buying into some of the really hot ones that pays them back for sort of being loyal. So that's one aspect. So basically that's the process, how companies go public. And then once they're public, it's just like any other public company, and they have to start reporting and filing, and they get traded in the public markets. And based on how investors eventually like their results, they either go up in value or down in value. So that's a lot, or that's a bit about IPOs. I should also mention that the initial public offering is the main way that companies go public, but it's not the only way. There are other sort of backdoor techniques. One is called a reverse merger, where a private company merges into an already public company that really has no business. So that may be a topic for another day. Lately, you're seeing a lot of companies that are doing reverse mergers into blank check companies, or what were formerly called blank check companies. So today they're called SPACs, special purpose acquisition companies. So there are management teams that are taking companies public and raising a lot of capital and telling investors that, hey, you're going to back my team, and I'm going to put all this money that you give me in a trust, and I'm going to look for a good company to buy. And so nowadays, because of what's going on partly in the tech sector, there are private companies that are going public through the SPAC route, which is sort of a backdoor way to go public. But so whatever way that they do it, once the company's public, all public companies have these certain obligations, and they get traded in the stock market, and they end up doing as well or as badly in the long term as the business that is in that public company. So that's a little bit about IPOs. I hope you enjoyed it. Hope you liked it. If you did like it, please subscribe and hit the like button, and tell other people about the Investing with Ken Majmudar YouTube channel. Thanks again. See you next time.